Good morning, it's Jeffrey Cohen. It's July 13th. Markets open in about an hour and a half. And where are we at today? So, first off, I'm an investment advisor representative with U.S. Advanced Computing Infrastructures Incorporated. You may know us as Chicago Quantum. We're an Illinois registered investment advisor. So, we're non discretionary. We don't take your money and invest it. We provide services, we provide advice, we do quantitative analysis, and we help you to make better investments. That's how we do it. And so this morning we're going to talk about the markets. It's very interesting. There's a inflation reading that's coming out, the CPI report, and I think there's a lot of focus. If inflation is really high, the Fed's going to slam down with higher interest rates and quantitative tightening. I can explain what that means, but you already know it, right? Which is they're going to make very, very short-term interest rates, policy rates, reverse repo rates, much higher, maybe as much as a percentage point. On the quantitative tightening part, that's what we think about. There's $8.9 trillion on the balance sheet of the Federal Reserve Bank. And they could be foreign bonds, they could be corporate bonds, they could be agency debt, which think mortgage-backed securities, or they could be just regular old U.S. treasuries, 10 years, 30 years, 2 years, 5 years. And what happens is, and even the shorter 30-day paper, let's say, and what happens is they decide they're going to tighten, they're going to take money out of the system. So they're going to hand people back their paper and take cash. Cash becomes more expensive. They're also going to raise interest rates. Makes cash more expensive. So they've talked about this for such a long time that the market assumes they're doing it. And so the market has valued the US dollar like a high-flying tech stock. Look at this chart. I just pulled it up. US dollar a year ago call it 90. That's a 107. Currencies don't move 20% in a year. Currencies move like 1%. Unless they're being gamed. And so, if you look at the rest of the little graphics, they're so pretty right here, right? The euro, steady decline. The euro reminds me of Avaya stock. Japanese yen, Avaya stock. Great British pound. It's a horrible thing. Now, the Canadian dollar, not so bad, because Canada is relying on a lot of oil and gas, and so maybe it's okay for the economy. So, not so bad. But in general, the currencies are bad. The dollar's so strong, and a strong dollar is really bad for corporate earnings for global companies. So, if you're a global company, you're getting earnings all over the world, you're converting them back to dollars, you report them in dollars. Oh, we did not have such a good, quarter, because 3 months ago, just to do the math for you, 3 months ago, end of March, US dollar was 97. Now the US dollar is at 102. Not bad, it's 4%. So I just took a 4% hit on all my foreign earnings. But from 102 to 108 means next quarter's earnings are going to be so much worse. You've already had a 5-6 point rise in the dollar. So net earnings not so good. Not so good. We're also seeing this in some other sectors. So, but what's interesting is the market, looks pretty good. Looks green. Looks good. Going up. No problem, sir. No problem. The VIX is down 27.15. If I were to look at this market without any context, I would say, oh, it's great. The long bond is coming down. Short bonds, actually, bonds are just going down today, which means rates are going up. I would say, well, that's no big deal, right? The interest rate's going up, no problem. So now I see the market. I'm actually quite confused by the market. So let's go to energy. How's energy doing? Well, look at that. Crude oil's down to 96. just in time for elections, midterm elections. Gasoline all the way down to $3.22 a gallon if you buy 42,000 at a time. This is before transportation additives, markup, taxes, whatever. So it's great. Super cheap. Gas is down, oil's down, and it's not just down in the U.S. It's also down at Brent, so over in Europe. So looks like a great day today. How the currency's doing, Jeff? Oh, euro dollar is about $1. Japanese yen at 137 yen per dollar. Canadian dollar, right? It's a $1.30. It takes $1.30 Canadian to buy a U.S. dollar. Gold 1727. That's down pretty good. You know, Bitcoin's under 20,000. So it's interesting because it's dancing around a support level of 20,000. It's fine. It's fine. That's kind of where I'm seeing it right now, is at 20,000. And so, did it go up a little? Did it go down a little? Sure. Now, we ran our model. More context, right? So before we get into kind of what's hot, what's not, a little more context. So we ran our down run. I'm just going to show you the top of it. The variance of the S&P 500 has flatlined at 1.6 times 10 to the negative 4. It's been there for a while, a couple weeks maybe. So the S&P 500 is not it's not increasing in volatility. It's about flat. It's elevated, but it's not accelerating. S&P 500 return is still very negative for the year. The Russell down like 23%. The QQQ down 20%. The S&P 500 is down a little more than 10%, inclusive of dividends. So that's not great. But if we look at our down run stocks, here you go. $1,443 stocks passed our validation. We actually dropped the floor, market cap floor, to 5 million. We do allow foreign headquartered stocks that are listed in the U.S. in our down run, because in general, foreign stocks have more risk. So if you're looking for down runs, if you're looking for bad things, you take some Chinese stocks. Take some stocks from like Peru, Costa Rica, Colombia, Canada, China, whatever. A lot of those companies are listing in the U.S. I guess it feels easier for them. The precision of our model is 10 to the negative 19th. So it's a very high precision model today with a very low quantum power. So what that means is risk almost equals return out in the market. The expected return, if you were to buy all 1,443 of these stocks, hold them evenly, is 6.125%, inclusive of dividends. And your risk is 5.3 times 10 to the negative 4. The S&P 500 risk was 1.5. Dog stocks that lose money is 5.3. So that's 3 to 3.5 times the risk of buying money-losing stocks. You still may want to. Wow, is that tricky math, though? Right? Let's take a look at the up run. Oh, don't show them all the answers, Jeffrey. Okay, don't look at that part of the video. Don't do it. Don't go back. Don't pause and look at the stocks we picked. All right. Same S&P 500 variance. Right? Same market returns, but now we do remove non-US listed companies, right? We did limit the market cap to 5 million and above. There's 2002 validated tickers of profitable companies. We also took out any cash flow requirement because positive net income without positive cash flow, I think we lost like 6 stocks. So if you make money, generally you make cash. We don't have to test for it. I actually thought like half the companies were going to be that way, and they're not. So that's good. So the power is higher in this model. The precision is lower. So profitable stocks, the precision is 10 to the negative ninth. Still a high precision, but it's okay. The power's higher, so your risk is lower for these stocks. There's more predictive power. Expected return is 5% on the bullseye for these stocks. And the all stock variance is 1.9 times 10 to the negative 4. So you compare that to 1.5 or 1.6, you're at 1.9, you're 20% higher. You get a 5% return. I'm still not sure this is a good bet to buy the stocks that make money. It's just interesting to see that you can reduce your risk by almost 3 times and only lose 1.5 points of expected return by investing in profitable stocks, a diversified portfolio of profitable stocks. And so I will share the top. Why not? This is not a portfolio, but these are the top rated stocks. And if you look at what's showing up, they're real sleepers. Well built. Berkshire Hathaway, Crestwood, P&M Resources, real sleepers. Marsh & McLennan, Sanderson Farms, Microsoft, Apple, Johnson & Johnson, Illinois Tool Works, ADP, Cintas, the NASDAQ Stock Exchange people, BlackRock, Coca-Cola. Where's Pepsi? Oh, Pepsi. Jesus. Lincoln Electric Holdings. So, Honeywell. All right. Mondelez Yum Brands. DTE Energy. Aflac. All right. So, Aflac's a reinsurance company, like secondary insurance. So, when you look at this run, you should be thinking something, right? First off, you're thinking, God, what a boring video. Because Jeff's talking about these boring stocks. So when I explain it, though, if you want to optimize your risk-return trade-off in a market like we have today, based on the last year of trading, what our model is suggesting you do, it's to buy the boring stocks. The best risk return is low risk stocks. It's McDonald's and Pepsi and Coke. It's manufacturers or tool makers like Illinois Tool Works, Lincoln Electric. It's services companies, ADP, NASDAQ. From a financial services perspective, it's the custodians, the large guys. It's insurance and reinsurance. Marsh & McLennan, Arthur G. Gallagher, Berkshire Hathaway. So you're not going to be popular at dinner parties. If you're a Gen Z, you're not going to go around and talk about, oh, I've got a nice long position in U.S. savings bonds, I-bonds. You know, I'm getting 9.62% for the next 6 months on my first $10,000 invested. Oh, I'm so handsome. Oh, and by the way, I'm excited about the improvements of McDonald's, Pepsi, and Coke. And you know, the insurance guys, the insurance brokers, Arthur G. Gallagher. I'm surprised I don't see Aon in here. Marsh & McLennan. Oh, you know, I love the way that they broker insurance. Oh, and then I just can't tell you how solid the quality is at Illinois Tool Works, right? This is boring. This is what our model says to buy in a bear market. So, very exciting. And in fact, here's the best part. That's it. I'm going to tell you. When you look at what the model picks, and by the way, we are burning chrome to get the, thank you, William Gibson, by the way, in order to get the best picks for you. We are running for hours. We are running all kinds of models right now to get the best picks. And you know who we're picking? Apple, Microsoft, Intuit, NVIDIA, Shenandoah Telecom, VMware. I don't know who RMR is. CHRD I actually looked up. BX is I always remember, is that BlackRock or Blackstone? By the way, we love Summit Midstream Limited Partners. And if we had money in our brokerage account, we'd be buying SMLP right now. Yeah, it's Blackstone. So hedgies. And by the way, we also personally like CG, which is Carlyle Group, but APAM. And then AFG is American Financial Group. So, and what's CHRD? So this is who it's picking. Oh yeah, Chord Energy Corp. Never even heard of Chord Energy Corp. Let's look at it over a year. I know nothing about it. It's gone up nice and steady, and then it crashed. From 170 to 100. So I don't know why the model wants you to get that, but my guess is Apple's going to have the same chart for the year. Yeah, so our model wants you to pick real dogs right now. Low risk. So interesting, right? So this is the pick. And you can go from these 11 stocks. By the way, it's 58 ticks of value over the S&P 500. And to go down to from 58 ticks to 53 ticks, which is basically no difference at all, you can go up 26 stocks. So now you can add Google, Broadcom, Qualcomm, Q-Rate, the QRTEA, the QVC people, Rocket Mortgage, LPG. I used to know what LPG was. I don't. Oh, MasterCard. So you can add Amazon. You could add a lot more stocks. You could have a fully diversified portfolio with basically no edge. No edge over the S&P 500. And so, tiny edge, 53 times 5.3 times 10 to the negative 5 edge. It's no edge at all. So that's what our model's picking, right? And so, what do you do when the risk return kind of process in the whole system is down? You have to look for your own edge. So one of the edges is www.cpi. The Bureau of Labor Statistics is coming out with a new CPI reading in 11 minutes. This is big. Good morning. So CPI will define the market this morning. So it doesn't matter what happens. What happens is the CPI reading is going to come out and it's going to change the game, right? There's huge trading programs that have been preloaded. See, we don't do that. But can you imagine they are, you think for a minute they're going to hold high beta stocks if they think this is going to happen? They have a huge thing to sell the high beta tech stocks with no profit, meme stocks, high volatility, high risk stocks. I've seen the list Goldman has. It's so beautiful. They take runs like ours and they preload all the buys and all the sells. So they could launch like 10,000 buys and 10,000 sells at one time. Not us. I got fingers and mouse. Oh, yeah, look at me. I'm going to trade one stock. Hope somebody buys it. So stupid. How could anyone with a mouse beat Goldman Sachs? Right? I don't know. I don't know yet. So if we look, though, what are the futures saying now? Market's up. So somebody must have a crystal ball, and they're saying that CPI is going to be pretty good, right? The VIX is down. No one's worried. There's no risk. The fact that the market has elevated variance, elevated price volatility, we're good. That's so funny. That's an anomaly right there. The fact that the VIX is down means that it's cheap. So the risk is cheap. Protection against risk is cheap. Doesn't make sense. So, I mean, I guess we could just sit here and wait. I could take questions. Let's take a look at some of the other data. Now, this is all stuff that you know if you follow us. So, I got a set of morning look tabs, 28 of them. Holy crap, Batman, that's a lot of tabs. This is what we do in the morning. We have coffee, kiss my wife, send her off to work. By the way, they're dealing with the COVID still, and they're dealing with parts shortages. Can you imagine? They got to worry about things like, can I find the spare parts to handle their business? That is awful just to think about it, right? Like, I don't remember a time when you had to worry about spare parts. It's like Atlas Shrugged from Ayn Rand. God, we need a new president. Not even looking at stocks right now. Indonesia chases G20 progress with Russia. By the way, one of the burning up here. One of the things, I need a place to type. One of the things that we should be concerned about is Russia called a special session. An emergency session of their Duma. They called in all of the high-ranking people from vacation, from their dachas, which is not normal. If you know Russia, they like their vacations. Nothing happens now. And so my guess is it's a war declaration against NATO, which will be super bad for stocks, by the way. So I'm calling there's a war declaration or something similar to that. Okay. Got anything about global markets? Gold steady. Recession fears way. Yeah, look at that. Russian ruble advances. Russia may be trying to form up a new BRIC consortium to challenge the European and North American hegemony, right? It doesn't actually matter if they do it. I think it's great, right? If they can be a little more self-sufficient, we wouldn't have to bail them out next time. But markets over the year, of course, down. Markets over 5 days have been up and down. Markets yesterday took a dump at the end. I was surprised by the strength yesterday, so it's kind of nice to see it. It just doesn't fit with our models, right? Market activity, you see advancers beat decliners yesterday on corporates, treasuries and agency. Actually, it's so interesting. Advancers slightly up from decliners. I like to look at market data on fixed income. Makes me happy, right? I look here, you're about 19-1 new lows to new highs. So our bear market thesis holds that market breadth is negative. It's 19-1 on fixed income. Although what's interesting is advancers beat decliners. So the top line number looks good. Oh yeah, Jeff. Bonds are great right now. But they're not. New lows to new highs. 20 new highs yesterday, even though the market went up a lot. I mean, it was a pretty good market, pretty safe market. But in terms of equities, U.S. equities, you have 18.5 to 1. Wow, it's just about the same for fixed income as it is for equities. Right? And you've only got 13% of stocks above the 200-day moving average. You get 28% above the 50-day moving average. This is a down market. More stocks declined than advanced yesterday. Stocks were looking, I mean, they opened lower. I thought, okay, they went down. Then they kind of flatlined, then they dropped again. So, just so interesting, right? So where are we at? Jeffrey, where are we at? So how did global markets do yesterday? Europe's down. Hang Seng down slightly. China was up slightly. Mainland China. India's down. What's going on with that? Europe's down. So basically Europe's down. They're probably thinking if we tighten because of a high CPI number, then Europe's got to tighten, and that'll drop the European numbers. You could see the E-mini futures on the Russell are actually up 8 points. I don't know what fair value is, though. You know, CNN does a futures fair value page. Let's see if I could just find it. Here we go. Yeah, it's interesting. So Dow futures, S&P 500 futures, NASDAQ futures, all going to be up. It's like nothing bad happened. Pre-market movers. An airline's down, Twitter's up. I don't know. I can't bet on Twitter right now. That's awful. All right, what else we got, Jeff? All right, so mortgage-backed securities look like they're going to open a little bit lower, slightly lower today. I do like to look at that. All right, yields. You know, 30-year Treasury at 3.14. We're heading back down to like pandemic levels of yields. But the 1-month Treasury bill is at 1.55, if we round up. 10-year Treasury below 3 at 2.95. And somewhere or another, I got a 3-month Treasury yield. Yeah, I do. U.S. Treasury. Where's my 1-month yield? I don't know. Can't find it. That's okay, though. It's out there. So bonds are going up, which is fascinating to me because if the Fed raises interest rates enough, you can invert the yield curve like in a week, right? This doesn't make sense. We're looking at an inverted yield curve, which generally was a sign of recession. Let's look at the COVID numbers. How are we doing with the COVID? Oh, that number's going up. 5,600. You know, when we started looking at this like a week or two ago, it was 4,900. Now, maybe it was 2 weeks ago. So the COVID's going up. I'm rubbing my eyes here. I'm dying. But the number of new cases is 106,000. So we might have underreporting. Or it just might be that the people that are testing and coming up with the COVID right now are hospitalizing more often. They're more sick. It could be repeat offenders where they get COVID over and over again. I don't think that's helpful, by the way. Yeah, futures are up. All right, the CPI number's out. Let's find it. Where'd it go? Here it is, CPI. There it is. Oh, that's nice. Okay. Did we shit the bed or not? The Consumer Price Index for all urban customers, CPIU, increased 1.3% in June after rising 1% in May, so it accelerated 30%. Over the last 12 months, the all-item index increased 9.1%. So that feels like a tweet. But I'm going to be a little bit rude about it. So CPI reading in. 1.3% month on month. 9.1% year on year. Through June 2022. CPI-U This is a shit-to-bed reading on inflation, and the Fed will tighten further. Waiting to see details on quantitative tightening and their $8.9 trillion asset sale. All right, and so I'll put the link underneath it. There it is. So for those who want the link. So what else did we learn from it? Broad-based. Gasoline, shelter, and food being the largest contributors. Oh, you don't say. Energy rose 7.5%. Gasoline was up 11.2%. Food was up 1%. I did notice that the prices were a little higher in our local grocery store. The index excluding food and energy rose 0.7 after increasing 0.6. Shelter's up. So I've got an issue with shelter. Shelter means affordability. Right? Month to month, 12 months. So we're up 0.6, 0.6, and we're up 5.6 for the year. Right, once shelter becomes more expensive, people can't afford their homes, right? And so when they can't afford their home, they got to go and rent. But rent is more expensive because property taxes are up, and rents are up, and interest rates are up, and it makes it more expensive. And so now you have people between a rock and a hard place because they can't afford to own, they can't afford to rent, gas is more expensive, food's more expensive. I guess you take a second job, but then you're not going on Amazon Prime and spending a bunch of money. Then you're literally scraping by day to day. So our current government has created a scenario where the middle class is going to get squeezed out into poverty. The rich won't care. They already own a home, right? The poor care a lot, but they're just going to suffer more. But that middle class that's hanging on with a 3-bedroom bungalow or a nice little condo, and the prices go up and the costs go up, and they're thinking, oh, I just made all this money, right? Because my condo's worth more. But then the property taxes go up on the rising values. And if you have to refinance your mortgage, maybe it's tougher because housing sale prices will go down as interest rates go up. The total cost of housing goes up, but your equity in your home goes down. And so it's not helpful. And then we go back to you got to buy 26 stocks equally in order to get the tiniest edge. So I don't know about you, but that means you can't make your business day trading, right? Because the riskiness of the market is so high. All right, what else we got? Is there anything else in here? How about apparel? How are we doing with apparel? Clothing. Apparel. Oh boy. Apparel was up 0.8%. It's up 5.2% for the year, but it's up 8.8%. Used cars and trucks burst much higher at 1.6%, or up 7% on the year. New vehicles up 11%. Thank gosh we bought our new Toyota was it about 4 months ago, right? When the prices only were going up 0.2. We got in. We just saved 3-4% on our vehicle. That's awesome. Paid cash for it. I don't want to borrow money. It's stupid, right? Paid cash for a car, but you know what? That hurt, right? Because I'd take it out of savings. What else is in here? Energy commodities are up 10%. I told you guys like a year ago. I told the Fed a year ago. Guys, douchebags. It's gas. It's oil. And don't tell me you're going to use ethanol and corn, because that's not a good answer. That's food. You're taking food out of people's mouths and you're putting it in a tank of your car. That doesn't feel like a smart trade. I'd rather be still and full than hungry and moving as a society. So looking at the futures, and what's interesting is the futures haven't really budged. So now let's do the part of the show that I like the most. Let's take a look at some of those canary in a coal mine indices that we look at. First thing we'll look at is our own holdings, just to fully disclose. Pre-market, Corbis, up 7%. I got to tell you, the day that Corbis hits $1, I'm giving all my listeners something free. I might actually give you a little show. I don't know. You tell me what you'd like. Corbis hits $1 and stays at $1. You get something from me. So you heard it here first. All right, what do we got? We got nothing else really moving pre-market. How about the walking wounded? The garbage stocks. The stocks have been going down a lot. Well, pre-market, most of them are red. Okay, even AMC. So I was thinking I would short AMC. What a crap stock. It's awful, right? But nothing's really up. The ups are less than 2%. The downs are about twice the size. Rio Tinto, Rewalk. God, Rewalk looks like a great short. The problem is it doesn't trade very many shares. It's not a very big company. So, banks, regional banks. Let's look at the broad regional banking system. This is interesting. Not a lot of stocks down. Not a lot of stocks up. So the banks aren't really trading, but it's safe. So there must be banks positioned for rising interest rates and certain banks positioned for declining interest rates. And this is when you kind of look and you see the difference. Let's look at our current efficient portfolio that we ran yesterday. It's red. S&P is going to fall. The pre-market money is betting against the low-risk, high-return model. So this is a bet against the S&P 500. So this is your anomaly right here. We picked a set of stocks that should outperform the S&P 500, but when the S&P 500 falls, they generally fall faster. And now I look at those stocks and I see those stocks almost universally are down pre-market. But the S&P 500 futures are up. So I don't understand how that can be. Money managers. How are we doing with the money managers? Oh, bunch of red. Oh, Robinhood is red. That's interesting. Robinhood is the most red. Blackstone is down 2.14% pre-market. But AllianceBernstein, who am I to judge, right? Janus Group out of the UK. Schwab is up. Brookfield Asset Management. So, all right, it's a mixed bag, right? Retail. How are we doing with retail? So I would think rising interest rates is great for retail because your credit cards get maxed out that much faster. No, I'm joking. Right? That was sarcasm. I'm sorry about that. I'm sometimes too sarcastic. So retail looks pretty red pre-market. What's interesting, though, is Dillard's is up. So Dillard's is a tightly controlled, family-owned stock. And so, they don't want it to fall this morning. But not a lot of ups. Just some. Sporting goods store. I think this Big Five sporting goods is a firm-specific thing going on. Dillard's is firm-specific. Foot Locker's firm-specific. They shot themselves in the foot. I think they bought back stock when they should have been bankrolling cash for the lean times. I think they just made a mistake. And I'm sorry that they made that mistake because I actually like the business of Foot Locker. Hydrofarm is down yet again, $3.14. Grow Generation is down again, but it's actually above 4. Amazon's down. The Gap continues to fall at $8. Etsy's down. Overpriced tchotchkes. Not a big driver in a high inflation market. Silvergate Capital down 7%. So they must be thinking Bitcoin is going to just roll over. Coinbase is down. Riot is down. CLSK is down. Marathon's down. Hut 8. Robinhood. So Bitcoin is at 19.3. They must be thinking Bitcoin's going to fall. Oh, look. The futures turned red. I knew they would. That's why I took the picture. All right? Let's go back. Current efficient portfolio is your canary in your coal mine, guys. I'm not making this up. I run this model now for a year. Okay? This is not a game. It's not a game. So the market is betting on a pretty big fall. The market is betting on a big fall in crypto-related industries, right? How about cannabis and tobacco? Oh, that's rough. Isn't it funny how it's 7:43, at 7:33, the market was up, it was green, it was great. You go back, you just watch the video. You go back, you're like, oh, Jeff, what's going on? The market looks so healthy. And now it's shit in the bed. I'm sorry to use the language if there's kids out there, but the CPI reading says that our economy is sick. You're going to raise interest rates and you're going to cause stagflation. There's no way the U.S. is going to stop global inflation. The only way to stop global inflation is to destroy money or increase economic growth. Now, some nations are doing it. China, Japan. I just heard that Chile, right? They're loosening things up. Mexico, they're loosening things up. They got to produce. They don't have a choice. That's like a person that can't afford their rent. You've got to produce. You need to lower interest rates, and you need to kill your currency, and you need to produce, and you need to sell to whatever market's left standing. That's the U.S. and Europe. Right? You don't have a choice. No one has a choice in stagflation, right? But when you're the United States and you say, well, I'm going to tighten it up, right? You're destroying the world's economy. We could be looking at a global recession. We could be looking at a global depression. And here I am talking to you about stocks like there's nothing going on, drinking coffee, right? I don't want to sound the alarm, but the alarm's already sounding. And now Russia's talking about war with NATO. You know, gosh darn it. And you know why Russia's doing that? Because the nations that are going to side with Russia, Brazil, China, third world, developing nations, they're all in trouble. They're all having to sell their products cheaper and cheaper to developed nations. And you know they feel bad about it because they're sucking the livelihood and the quality of life out of their own people in order to just survive. Maybe pay some sovereign debt, right? How we doing with chips? Chips and dip. Love it. Semiconductors, all down except for Excellus, which is a pretty small one. So that also might be firm specific. Trucking and transport, pre-market, not bad. Not bad. There must be some good news in the CPI numbers. I didn't see it, but there might be there. Computers and chips, Apple, Microsoft, Oracle, Dell, they're all down. HP, HPE. This is business to business, guys. So business to business and business to consumer is red this morning. Big or small cap, it doesn't matter. So, yeah, a big CPI rating is not great. Doesn't help. Now look at the futures. First off, look what it does to our model run. Right? I mean, it's a crap sandwich. This is a crap sandwich. And I don't like it. Just so you know, I don't want the markets to fall. I want the markets to go up. I'm like the most optimistic guy that you ever met. Right? I love when markets go up. I really do. I'm optimistic on America. I mean, I love America. And I want it to do well, right? Like I look at the NASDAQ, I drew some lines there. You know, the kind of the up and down lines. Because it was falling and it was a bear flag, so it was coming down. Look at that, coming down. And then it flatlined, and I thought, oh, it's a bear flag, right? Down and up. Just be patient. I don't know which way it's going to go. But it looks like it's picking a side now because it is. It doesn't mean it has to finish this way, but it's breaking down to the bottom of the bear flag. So NASDAQ, bear flag, problem. Now let's take a look at our holdings. And my guess is we're still not going to make any money today because it's really hard to make money when you're a little guy like me, right? So we have puts on Bank of Hawaii. We have puts on Lakeland Financial. And when I look at it, I think we're the only person who bought these puts. So if you're listening, please let me out. Let me out of the trades. You got to help me here. Help me. Let me out. Let me make a couple of shekels of profit. Walk away a winner. And I promise I won't attack your stocks anymore. Right? American Shared Hospital Services and Corbis. And let's talk about it. Corbis is a couple of dollar stock. It will get acquired. I mean, right now there's a great positioning, right, with their new drug portfolio. They're head-to-head against Pfizer. If you're Pfizer, why would you even waste an hour? The stock is worth $36 million. The book value of the stock is like half. It's 0.6. So you can get like $60 million. You could probably buy this company for $250 million. Roll in all the researchers and just wrap this thing up. And then Pfizer gets a multi-billion-dollar blockbuster to make tumors smaller. And then Pfizer can also go after the market for obesity. It's just it's such an easy buy for Pfizer. Wrap it up. I think people know that, right? Now, American Shared Hospital Services, well run, tight. Look at that price to book at 0.7. This is easy a $3 stock. Easy peasy. It could run much higher. It's a tiny company. I like the stock. I should buy more. Right? But you got to let me out, right? So I am betting against Bank of Hawaii and Lakeland Financial. And here's why I did it. And here's a good lesson for all the folks out there who know me. I'm not so good at the whole stock market thing, right? But what I do know is I know that if you're a bank, my God, look at that. And we'll look at this for a minute. If you're a bank, you take in deposits, you make loans, that's fine. But if you take in deposits, make loans, and then juice up your returns by pumping billions of extra dollars into high risk, long duration, fixed income bets, including mortgage-backed securities, then I think you should go to prison. And what's going to happen is you're going to destroy the shareholder equity in your bank. You're going to have to borrow money, whether it's from the Fed, whether it's from the discount window, whether it's commercial paper, whether it's selling bonds. I don't care. You just destroyed the capital cushion of your business. And I found two stocks that were destroying the capital cushion of their business. And what's interesting is this is 30-year bond. Now, they're not holding necessarily 30-year bonds. They might be holding 10-year bonds, but it just makes the point. So they were making a ton of money. Look at those bond rates. Bond prices were at 163%. So that's 63% higher than par. And they came down to February, but sure, they came back up again, 160% of par. Now they're at 140% of par. That's a drop of 20%. So if you invested $1 billion and you lost 20%, that's a lot. And now you get a mark to market. Now, the good news is our accounting system doesn't require you as a bank to declare that loss. You just say, look, I'm holding those investments till their maturity. Far be it from me to say that they go up, they go down. They're all the same, right? We got this. Jeffrey, it's no problem. I'm updating my balance sheet. You can see the facts. But net income, I made $25 million this quarter in net income. I lost $200 million in investments, but I made $25 million, so I'm going to pay $25 million in dividends. And I'm going to celebrate with a free toaster in every branch. But yet you're destroying the capital base of your business. And Lakeland Financial and Bank of Hawaii are both destroying the capital base of their corporations. And that is why we're betting against them, because it's not right. It's not fair and it's not right. Don't do it. Don't destroy the capital foundation of your business. Lakeland Financial, you guys have a business to serve the Hoosiers. Serve Indiana. Make loans. Take in deposits. Be good to people. Create jobs. Bank of Hawaii. Do you know when you buy a house in Hawaii, it's like $1 million. You have to provide mortgages, safe, low-cost mortgages to the people of Hawaii. Instead of telling people to go travel to Vegas and use credit cards, and instead of pissing away your capital foundation, right? This is where I'm at. So, let's see. Let's to summarize, right? So we started talking, market looked great, right? Oh, it's going to be great, right? Here were the stocks I gave you. Those were the low-risk stocks. This is where you wanted to invest your hard-earned shekels to try to beat the S&P 500. But it's a tiny edge, so maybe you should just put your money in the S&P 500 if you have to be invested. Or QQQ or whatever. I talked about Russia calling an emergency session. Personally, we're forecasting a declaration of war against NATO. Right, the bear market thesis, we're still in a bear market. Market breadth is strongly negative, 19-1, new lows and new highs. Your NASDAQ composite 100 is in a bear flag, and it's testing the lower range. That was another thing we talked about. And then we talked about just overall CPI shit the bed. I'm sorry if you're a child or you're sensitive, but they did. The CPI rating was terrible, and it's going to cause a pretty big reaction from the Fed. We looked at our economically sensitive areas, such as the currently efficient portfolio. All red, except for Shenandoah Telecom, which is why you hold stocks like that, because they don't move. They're safe. The walking wounded. They're walking a little slower right now. They're more wounded. So I talk about fear of missing out is a cost-effective strategy in this market. Well, it still is. And what do I mean by that? Fear of missing out says, don't catch a falling knife. Today, and FOMO is a cost-effective strategy. Today, if the stock is cheap today, likely to be cheaper tomorrow or next week. Remember, we have a 19-1 new low to new high ratio in both fixed income and equities. It's so symmetric. Corporate fixed income. And of course, U.S. listed equities. It's not good, guys. Don't catch the falling knife. I mean, unless you got money to burn, right? What else you got? Let's look at our regional banks. How the banks doing? I don't think the banks mind. This is so interesting. I don't think the banks mind rising interest rates. There may be some banks that are positioned to make money in a rising interest rate market. Look at that. Bank of Hawaii is up a penny. It's beautiful, right? Positioned. Maybe that's it. Money managers, yeah, they're down. Except for T. Rowe Price actually is the one that's up now, and Janus. Something happened with Janus. They had some issues. And so I think their stock just has been recovering for a while. Wayfair, Etsy, Carvana, you name it. These are the specialty retailers. Grow Generation, they're all down. What's up? Joann Fabrics, Shoe Carnival, Big Five Sporting Goods, Burlington Stores. This must be the recession thing, right? When you can't buy art, you go to Joann's and you buy thread or yarn. Pre-market and the crypto and the miners just is awful. Right now, I guess Bitcoin's going to crash right now, right? Because interest rates higher, you pull your money out of Bitcoin. Steel Dynamics is up slightly. That's interesting. That must be specific. They're a servicer. So they take in the steel and they make pieces, and they service much smaller customers, right, who can't buy 45-ton coils. They sell 1 ton. And they break down the coils and they make parts for people. Chips and semis, all red. Economically sensitive area. Cannabis and tobacco, all red except our best friend, Corbis Financial. We own Corbis Financial. We love Corbis Financial. We think this is going to make us a lot of money. This is our bear market thesis, is Corbis is where you want to be right now. It's easily a $1 stock. It could be a $2 to $3 stock. It's trading at 30 cents. All right, how are we doing on the treasuries? Treasuries are up as expected, right? The Fed's going to raise interest rates, so the treasuries yield more. Price goes down. Let's take a look. Let's go back to our futures. First off, let's go back to crypto. Did it respond? Yeah, it dropped. It's at 19,100. In our mind, crypto, Bitcoin is still at that support level. Ethereum still at the support levels. XRP, oh my God, WXRP in Cincinnati, still at support levels. Just showed my age there. That's fine. The euro at a $1.16, it's gonna break the buck. That's awful. Foreign exchange, the Japanese yen is approaching 138. Canadian dollar broke 130. Euro dollar will break. Futures, U.S. equity futures are down between 1.5 for the Russell and 2.25 for the NASDAQ. Europe rolled over, down 2%. The VIX is up 5%. Crude oil continues to fall. Gasoline is down almost 10 cents a gallon. Copper 3.25. Copper's in a free fall. By the way, copper's a $2 to $2.50 an ounce commodity in a recession. So I wouldn't be surprised if copper makes its way down to $2, which means Freeport-McMoRan is in trouble. Silver at $18.89. Let's look at FCX. Freeport-McMoRan is in trouble. Look at that. Peak of 50, down almost 25. Yeah, I know you can call this a head and shoulders. It's beautiful, and it's because copper's falling. So that one makes sense. Freeport-McMoRan, I mean, at some point we're buying, but I just don't know when. The same thing with Cleveland Cliffs. Cleveland Cliffs, peak of 30, down to 15. Someday we're buying. I just don't know when, right? Newport Mining, great company. Peak of 85, down to below 60. We're buyer, but I don't know when, right? Look, cannabis stocks, I don't know. It's hard to imagine people getting high when they can't afford their rent. What else we got? It's hard to know, right? Because I'm expecting weakness with the banks, and I'm just not seeing it, right? And this is where it's just so fascinating, right? I just don't see the weakness. So I don't know. I mean, maybe the banks know something we don't know. Maybe they make money on fees. Maybe they're doing something. But the fact that bonds are going to crash right now means, and maybe it's because they're not crashing, or maybe it's just because the futures aren't updating. But you're at 137.81 on the 30-year bond. You're at 117 on the 10, and you're at 111.68 on the 5-year. So we saw the 30-year bond kissing 130. So maybe that's why. Maybe the bond yields, long-term bond yields aren't high enough, right? I don't know. So is there anything you want to be in today? Is there anything kind of up and at 'em and exciting? Let's go back to our walking wounded. Sometimes there's something there to play with. So auto web, it's interesting. This is a tiny play though. I mean, if enough people play it, you destroy it. So auto web, we love this company. Tiny company, 6 million market cap. It's going through restructuring. What happens is that the people aren't buying new cars, and so their clients aren't hiring them. They connect buyers and sellers. They're going through some restructuring. The fact that the market cap's down to 6 million, this company's probably going to survive, restructure and survive. But I used to play this thing from $2 to $3. Now it's at 50 cents. I don't want to touch it, right? But that's maybe a play for some people. I mean, you know me, I love Corvus. Let's take a look. How we doing? How's Corvus doing? It's a crap sandwich. I hate this stock. It's one of the worst investments I've ever made. Let's look at AMS. Tight pattern. Tight pattern. If we stretch it out a little, you can see it. Tight pattern, and it looks like it broke out yesterday, but I do believe it broke out yesterday on some just some excitement, right? Like some people took a bet, took some excitement on that one. So I don't know if it's sustainable or not. It's just hard to know. Don't know. And so we're going to watch the markets this morning. We're going to go into our NASDAQ book viewer. And again, going back to CPI, headline numbers, Bureau of Labor statistic, is that inflation rose 1.3% in June. So that's really high. Because they rose 1% in May. And then so it's a 30% acceleration in June. And over the last 12 months, they went up 9.1%. It's accelerating. It's awful. I mean, just cry. Right? Just cry. It's not a good news. So, nice. What do we got? We got 7,500 tweets on CPI. Okay, that. Booyah. That's just funny. I don't know. It's awful. 40-year high on inflation. And I don't think it's Creepy Joe, by the way, because inflation is global. It's not any one politician anymore. It's just we have a world of inflation, and we are destroying our world economy, and I don't know why. It's stagflation writ large. It's awful. It's awful. Let's summarize. You know, I like to summarize. What do we got? Well, we still have bonds not doing that great, right? What's Koi Fin have to say? I think we're done. We're wrapping this up. It's 8:06. I got to get my game face on, right, for the stock market. COVID numbers are higher. That was the other thing I noticed. COVID's up. COVID hospitalizations are up, even though new cases are flat around 106,000. COVID hospitalizations are up to almost 6,000 per day, even though new cases are flat at around 106,000 per day. It's interesting. So COVID's not gone. You know, what's interesting about the 10-year at 3.05 is it's still not that high. It is still not that high. The 30-year, 3.21. We're still not seeing high rates. And the question is, what about the 1 month? 1 month at 5.76. So what you should be thinking about is, if the 1 month is at 1.5 and the 30 years at 3%, that spread is 1.5%. To go from 1 month to 30 years is 1.5%. That premium is not a lot. And if the Fed raises interest rates by 1% and the 1 month Treasury goes up 1%, now you're at 2.5% to 3% on the short. You're at 3 to 3.5% on the long. You're inverting. And when you invert, people get scared and they talk recession. So, all right. Hope you enjoyed the stream. Hope you learned something. Hope I didn't babble too much. And if you liked it, hit the subscribe button. That helps us. We do not advertise our site. We do not get paid to make the videos. We do it for you. And so just hit subscribe and drop a comment below if you liked it. We like that. That helps. And you can always check out the website at chicagoquantum.com. Take care now. Good luck. Be safe.